Hello, dividend growth stock investors. Happy Friday to you. Congratulations on getting through your 9 to 5. If the work week's not over yet, if you're still going out there working weekends, side hustling, more power to you. My name is Colby, the DGI Crab. Very happy to have you in here for the video that I do every week on the final day of the trading week, which most of the times does happen to be Friday. We're going to go over each of the stocks in the 4 tiers. If you're new here, this channel focuses on 60 high-quality dividend growth stocks that pay out an ever-increasing flow of tax advantage, for the most part, passive income. Going to take a look at which ones are undervalued, and at the end of the video I'm going to show you exactly what I did this particular week in my own tier. I've broken down each of the tiers in categories based on the age and timeline of the investor. I'll explain all of that as I go. If you're new here, you won't be lost. So I actually had started a Webull portfolio so I could build up a portfolio from the ground up and show you that progression of exactly how this is going to work. I wasn't a big fan of the user interface, and the dividend reinvestment plan had some restrictions on it that I didn't like. And I asked you in the community to give me some recommendations on a brokerage that would work out a little bit better. And shout out to all of you who gave me the suggestions because it was unanimous. You all said Fidelity, so shout out to Jeremy and Lance and anybody else that weighed in. You all had the same opinion, so I went with Fidelity, and you know what? I am really liking Fidelity. It's got everything that I want in it and a couple of pleasant surprises, so I'll be able to be very transparent with you and show you exactly what it is that I am up to here on the 1st of November. All right, so just in case you are not aware, this is how I handle my portfolio. This is the DGI Crab investing strategy. Now, I'm not a professional financial advisor, so don't do anything whether just because I told you to do it or told you not to do it. You should always do your own due diligence, and you can come up with your own strategy, maybe base something off of this, but this is exactly how I invest, and it's working out really, really well for me. So I do minimum 50% goes into age-appropriate ETFs for automatic diversification. Stocks that are yielding 30% or more above their 4-year average yield is exactly what I'm looking for the other 50% of the money. Now, if my top 10 favorite stocks hit that 20% yield above their 4-year average, I will bend the rules a little bit, so to speak, and invest in those regardless of what tier that I happen to be in, because I just think those 10 are that good. Now, I'm going to remain within my tier unless there's a stock in a different tier that is yielding at 50% higher than their 4-year average, because that's, to me, indicating major undervaluation. And then finally, if there don't happen to be a viable stock within a particular tier, then I just will double down on ETFs, not trying to time the market in terms of when I'm putting the money in. If there's not a good value in a single stock, no shame in just putting more money into the ETFs, and that'll actually get me above 50% ETF allocation. All right, so that is the strategy. Now let's take a look at those tiers, you guys. Well, as always, we're going to start out here with tier 1 for the 18 to 30-year-old investor, where the goal is to acquire lower starting yield and around the 1.5% range. But what we want to really look for here is a dividend annual growth rate well above 10%, maybe more in that 12% range. So we can really compound over the long haul that passive income. Nike and Nordson remain our two best buys here, and we're looking at the valuation tab, and if it's in green, we have hit that 30% or more higher yield, or I'm comparing the 4-year average yield to the current day yield, and that's where this number is coming from. So Nike and Nordson looking like great purchases for the tier 1 crowd. For tier 2, so guys, I'm going to be in tier 2 just for another year and a few days. I'm turning 41 over the weekend, and this is going to be my final year in tier 2. So I'm really glad that I'm starting out this new portfolio so I can do a final year for it in tier 2 before graduating on to tier 3. So the tier 2 investors, the 31 to 41-year-olds, you're looking for starting yield in the 2 to 3% range, and you still want to get an annual dividend growth rate in the high single digits at least, so at least 7%, but hopefully closer to 10. Hershey and Target are in that buy zone, pretty similar to last week. Hershey remains the number one most undervalued stock in this tier. I am very happy to continue adding to my Hershey position. And Target was not quite there last week. It was like at 29.9%, and it just crested that 30% here this week. So did I add a target position to that DGI grab portfolio? I'm just gonna have to wait and see. Tier 3, age 42 to 53-year-old investors. The starting yield's going to be a little higher in this tier. We're really looking to get more like 3 to 4% starting yield. Still want a nice annual growth rate, but maybe it's going to be a little bit more like 5 to 8% on the high end for that. Got 3 stocks in that that are in that category. Archer Daniels Midland has now gone above 50% undervalued. So just like with Nike in tier 1, Hershey in tier 2, this one is open season regardless of what tier you happen to be in. As far as I'm concerned, this is a great stock trading very much on sale right now. I think ADM's eventually going to recover. It's been a rough year for them, but this is a fantastic buying opportunity for ADM. GPC had a big fall last week. They continue to just kind of slide a little bit lower down than they were last week at this time. I really like this dividend king. Reported a terrible earnings quarter last week, and they're going to take a little bit of time before they recover from that, but just give it a little bit of time, and in the meantime, you can enjoy a very, very high starting yield when you purchase that at right now yielding 3.5% when it's usually closer to about 2.5% based on that 4-year average. So nice starting point there for GPC if you don't have any of it just yet. For the tier 4, the 54 and older crowd, we want to get starting yield cumulatively at least 5%. We don't have as much time for the annual dividend raises to really compound. So if you're still actively adding to a portfolio to get to financial freedom and you're in that 54 and up range, as much as I like stocks like Hershey and Nordson and Nike and all of those, you probably are going to need to get higher starting yield than that for the most part. You still want to get that annual growth rate to meet normal years of inflation. So I'd like that to still be at least like 3%. But we got to get the higher starting yield, and there's just still not a lot of bargains here. Realty income is starting to come back down a little bit. And it's not, it's not the worst deal in the world here right now in the $58 range, but honestly, for me, there are a lot of high yield ETFs that I'm going to go over in the strategy tab that I would probably prefer to focus on rather than loading up on a single share of a stock that's still not super on sale. Altria Group, by the way, wow, they had reported a really nice quarter, and that stock continues to go up and up and up. I remember the time when Altria stock, just within the last 12 months, I believe, was trading down below $40 a share. It has, if you were buying it down there, not only have you gotten an excellent yield, but you've gotten some great price appreciation too. So that's why I do the strategy the way that I do it. I want to buy the stuff when it's low so I can get the share price growth and the higher starting yield. What do you guys think? All right. This is the tab I keep separate just for the top 10 stocks. So these aren't new stocks. These 10 are all located somewhere between tier 1 and tier 3. That this is the group that I mentioned at the beginning. If they hit that 20% undervalued mark, I will go ahead and buy them regardless of the tier I'm in. Pepsi came so close today, and I didn't pull the trigger on it. I'm going to have to get Pepsi down below 165. I'm going to be a little bit of a stickler about it, but I'm going to be keeping a very close eye on Pepsi next week, because if it goes down just a little bit more, I'm definitely going to be jumping in and adding to that Pepsi position. Everything else, very much either just kind of right in line with what they typically are yielding, or if not, they're very much overpriced, unfortunately. So what does the strategy look like if you were to invest, say, like $100 or something like that? For tier 1, these are the ETF allocations, right? So tier one investors, I think about the right allocation would be 25% S&P 500, 15% small cap value, 5% dividend appreciation, and 5% international. VYMI is the only non-US stock position that I have. I do really like this high yielding ETF. Tier 2, same for ETFs, just rearranged a little bit. Dividend appreciation at 25%, S&P at 15, small cap value 5, international 5. Tier 3, a little bit higher yield focusing ETFs like VYM, SCHD, or DHS. I love all three of these. As you know, these are three that are included in the great ETF race series that I do every other Tuesday. Go check that one out if you haven't already. And you could do an equal allocation into all three, or maybe just load the boat on one if you think one is particularly better than the other two. That's fine, but that's about the breakdown there. And then your tier 4 investors, you still get some ETF exposure here with some alternate investments. So your SPYD is going to give you your stock exposure, SPYI high yield bonds, PFFA for preferred shares, MLPX for MLPs, Devo, Jeppy, and SPYI for covered call strategy. And then still, you've got your international down here. Then this is how I break down the stock purchases for the week. So for the tier 1s, if I was in this category, I'd be doing 30% into Nike, 10% into Nordson to give me those two that were in the green back on tier 1. And then because both Hershey and Archer Daniels Midland are at that 50% or more undervalued mark, I'm going to reach up and do 5% into each of those two and maybe start gradually building those positions up. Because again, I'm still going to get a lot of share price appreciation on those over the long haul, I believe. Now in tier 2, this is what I did for the week. We got 25% into Hershey, 10% into Target, so that covers my tier 2s that were in the green. And then I did 10% into ADM, because really I think the difference between tier 2 and tier 3 is fairly modest. So I went ahead and did a 10% into ADM, and then 5% reached down into tier 1 and kept on adding that Nike. Now, tier 3 being right in the middle here, you've got a chance to do a lot of things. So there's your Archer Daniels Midland at 15%, Hormel and GPC at 10% each. That covers the tier 3 stuff that's undervalued. And then going down into tier 2 to do 10% Hershey, and down into tier 1 to do 5% into Nike. So a lot of different positions there that you can consider adding on, and I like to just sort of spread out the love a little bit as far as that goes. When there's multiple good deals, just keep peppering in, little bit here, a little bit there as you can. And that's how you build up that passive income. And then for tier 4, hey, there just wasn't anything in that tier 4 category, so I'm going to keep doing the ETF double down. Instead of 15 and 5% all the way through here, it would be 30%. 10s all the way down. Still just going to do 5% into the international, and I will reach down here into tier 3 and grab a 5% ADM here as well. So Archer Daniels Midland all the way across the board in all 4 tiers this week. Definitely liking it. So the DGI portfolio here, I want to show you what I did here for the week. So this is what I did as a tier 2 investor. Just kind of laid it out on the previous tab, but with $100 in, it was 25 Hershey, 25 VIG, 15 VOO, 5 Nike, 5 VBR, 5 VYM, 10 into ADM, 10 into Target. Over here, it shows exactly how much forward annual income I added with each of those investments. So then the grand total for the week was $2.35. And just so you can take a look at it here, this is the actual portfolio here on Fidelity. Basically, the same information here is on the spreadsheet. Fidelity just does a very nice job of sort of laying all this stuff out for us. And something I wasn't expecting was you've got the overview here, but then I can go to the dividend view. I'm going to like that. And I can sort this and look and see what my annual forward dividend income is going to be based on that. It's going to show me my like my ex-dividend dates and things like that. So that's going to be really handy. Thanks a lot again, guys, for the recommendations on this one. I'm really looking forward to getting this one built out and showing you exactly how you can do this little by little.